evening, dear members, for today's investor awareness program. We have with us to present on today's topic CA Santhosh Maller. Welcome all of you for today's program. We have today's topic on discussion how to calculate intrinsic value of shares. Hearty welcome to each one of you. To give a very brief introduction about our speaker, having passed the CA examinations with All India merit rank, he has worked for Big Four audit firms in FRS desk for more than a decade. He has over 16 years of professional experience in accounting, advisory services, audit and assurance, including in large audit firms. He has extensive experience of dealing with complex technical accounting issues across various large clients that his firm has served. He is a member of Accounting and Auditing Committee of Bombay Chartered Accountants Society and has delivered several lectures and facilitated technical workshops. With this very, very brief introduction, I wholeheartedly welcome you, sir, for today's program. Hearty welcome to you, sir.
Thank you, madam, for the introduction. And
over to you.
Yeah, am I audible?
You're audible, sir.
Okay, thanks. So thank you for the kind introduction, and good evening, everyone. Welcome to the session. The session is with regards to investor education, and in that context, it's intrinsic valuation of shares. So far as the intrinsic valuation, the topic itself is quite it's like an ocean, right? It's quite a wide topic because valuation is a topic on its own, and especially in the current context. And I can appreciate the reason why the organizers have kept the session now, because friends, we are seeing almost every week we are seeing 3 or 4 IPOs being issued. We are also seeing a flurry of stock market transactions today. If you look at the levels at which Bombay Stock Exchange indices have gone, or even for that matter, globally, the stock exchanges, the levels at which certain companies, the shares are quoting, there is obviously a lot of optimism in the way it seems to have been priced last year, and we haven't yet come out of COVID pandemic as yet. And of course, as we speak, there are concerns about new variants and new waves of corona pandemic. But despite all that, notwithstanding all that, we still have very buoyant capital markets, a buoyant stock market, and a lot of people are cynical about it in terms of what is the basis of valuation. So a stock which was valued at let's say 100 rupees last year is being quoted at 300 rupees, and of course every now and then there are certain free falls, etc. But what is the basis of this valuation? So that is probably in the context of which this session was planned and organized. The other issue, friends, is also we are seeing a lot of new age companies with non-conventional business models emerging and attracting investments, very attractive investments. This calendar year itself, we have seen about 42 unicorns. Unicorns are the ones which have valuation in excess of USD 1 billion. So 42 unicorns in this current year. On an average, since last 6-7 years, it has been in the range of 20, 25, etc. But 42 in a year, and that too a year which saw the second wave of COVID-19 pandemic. It's kind of a lot of people are not able to fathom why is this, why all of a sudden there is all these new age companies attracting a lot of investments and valuation. And also conventionally, many of these companies, so for example, Paytm or Zomato, they are all in losses, right? They are not like they are not like even making profits. So a lot of people are wondering why is it that what is the basis of the valuation? So what is the intrinsic value of such shares, and what is the basis of such valuation? So it's quite a crazy world in a sense, but to make some sense of it, there are certain valuation requirements, valuation rules and methods, which we will see during the course of this session over next couple of hours. What I'll try to do is touch upon various methodologies when it comes to valuation, intrinsic valuation, and also we may have the session free flowing because I'm sure you all would have many questions and many perspectives. So I would encourage all of you to participate as much as possible in this session. Madam, is this so? Is it so? If somebody has a question, is that they will have to type it out in the chat box, or how is it the participants will communicate their questions to me? Divya, madam. Okay. Anyhow, so I guess you all will be able to unmute yourself and speak up the question. Madam, you're there?
Ma'am, sir, actually they can put in chat.
Okay. So
You
good.
can see the chats. Yeah, yeah.
Okay. So in case anybody has questions, please feel free to raise the questions on chat. And so chat will be visible to me, or is it going to be visible to you only?
Sir, chat will be visible to you, sir.
Okay, okay, fine. So during the course of the session, I'll try to, take the questions so that, we keep the session a little interactive. So with that little background, let me start the session. First of all, talking about intrinsic value. So what is intrinsic value? So intrinsic value is the anticipated or the calculated value of a company's stock determined through fundamental analysis. So, for example, let's say if we are talking about Paytm shares, right? It got issued at around 2000 rupees per share. It got listed at a heavy discount. On day one of the listing, we saw a fall of about 35, I think it was 40%. Okay, so what was the issue with regards to, so what was the intrinsic value, one may ask? Was it the issue price? Was it the listing price? Or was it something else? So intrinsic value has got nothing to do with issue price. And also it has got nothing to do with the listed price, right? Because the code of a share is essentially a function of what is the value of how the buyers and sellers are functioning, and it's a interplay of the demand and the supply of that for that share. So basically, when it comes to intrinsic value, it is the anticipated or the calculated value of a company's stock. Now, so the highlighted terms are anticipated or calculated. So why anticipated? So anticipated would mean that if I were to buy the shares, okay, and if the counterparty, so two willing parties having full knowledge about the fundamentals about the company, about the stock of the company whose stock is being valued, are actually having a negotiation, and they are actually willing to trade. Okay, they have the ability and they have the knowledge, the full knowledge. So it doesn't it does not work based on any non-transparency. So if I have to determine the intrinsic value of a share, it has to be based on complete knowledge of the company, underlying asset. I cannot say that I have, so to say, bluffed the investor and I have, not disclosed the proper, state of affairs of that company. And I have negotiated that way and I have derived at the valuation. That doesn't work. So the underlying assumption is, which is why you have in private deals, you have due diligence, and also in stock market, you have investor meets or analyst on calls, wherein the media asks various questions to the management of of the company, so that the full knowledge, full disclosures are aware. And obviously, you have the reporting, the financial statements, the quarterly financial results, as well as the annual financial results. So the underlying premise on which valuation is built is that you need to have full transparency, full knowledge, and the investors, the two buyers, the two buyer and the seller, the two parties to the valuation have full ability and willingness and knowledge to transact. They are not like so if the buyer has the financial ability to invest funds in that company or to buy shares of that company, it's not, it's not like a window shopping where basically the investor is just making an inquiry. There is a transaction that is anticipated, and in anticipation of that, the valuation is being derived. So the basic premise in which we are talking about is that the valuation has to be, the buyer has to have that anticipation and the willingness and ability to transact in that company. Let's say, for example, valuation of, say, Paytm. Okay, Paytm. So Paytm, of course, I have a separate example in a subsequent slide. But let's say, for example, Air India. Right, Air India. We know that after so many years, the government has managed to sell Air India. Tata is the successful bidder. So from the perspective of Air India's share, the intrinsic share. So of course there was, they had to carve out the debt, the liabilities, etc., the borrowings which Air India had, had in its books, and that will not be passed on to the buyer, to Tata Group, but it will be only certain aviation assets, certain fleet of aeroplanes, and various other things. So let's say, for example, if I were to do a valuation of Air India, it would be based on an assumption that Air India will be working on a going concern assumption. So even if today it is under financial distress, okay, but as a buyer, as an investor, what is it that I am bringing it onto the table? That has to be the basis of the underlying assumption. So I cannot be saying that I will be, it is a non-going concern on a distress sale basis, saying that, I'm going to close down the company, and on that basis, I will be working out the valuation. Valuation, the underlying assumptions has to be based on the fact that I am basically going to operate the company on a going concern basis. Otherwise, there is no valuation. There is an anticipation. So the term anticipated or calculated, that is what I'm talking about in this example. Another example is, let's say, that of, say, a company like, say, Future Group, right? Future Group has been in talks with Reliance to dispose, to sell its business, to requesting Reliance to take over. Now, of course, Amazon and it's still a matter of it's sub judice, and there is a court case which is ongoing. But let's say if Reliance Retail was to take over Future Group business, it can have various things, right? It can either decide to run it as it is, or it can decide to cannibalize the brand and just leverage on the leases, the supply chain, the network, etc. So in either case, you will have to do a proper valuation on the basis of going concern. So despite of the fact that they are under financial stress, etc., fundamentally, when as an investor you are acquiring a company or you are investing in a company, the underlying anticipation basis has to be that on a going concern, the operations of that company will continue, and therefore you cannot assume that it will be closed down or it will be wound down as such. The second bullet point, it considers qualitative and quantitative factors. Now, what are examples of quantitative factors? Expressed future cash flows, cash flow projections. You will have the discount rate, the WACC, growth rate, uh, the terminal growth rate. So generally, if cash flows are projected for next 5 years, beyond 5 years, if the business survives, you will have, a growth rate assumption that cash flows will be growing at a certain rate. So those are the quantitative factors. So your discount rates, your WACs, your growth rate, your cash flow projections, so on and so forth, right? So those are important, and those are particularly important because intrinsic value is all said and done. It has to boil down to a number. Okay, there has to be a quantitative part to it, which is what would make it, so valuation is both a science as well as an art. So why is it a science? Because there are underlying numbers. So there has to be some numbers which underlie the entire valuation exercise, right? It is an art because there is an aspect of quality also. Quality also. Why? Because let's say, for example, you are valuing land parcels, okay, or shares of landowning companies. And if you have, let's say, for example, the house, okay, the land or the property which you are, valuing is occupied by, let's say, one of the billionaires or one of the leading industrialists or one of the celebrities. So, for example, we know that for a fact that, many a times when there are auctions of, homes which were earlier owned by some of these Bollywood actors or even, some of these leading businessmen or leading models or socialite, then in that case, at times those addresses will, fetch a higher price. So, for example, imagine, let's say, if there is a auction for some of the properties around Bandra. Right? So I'm based out of Mumbai. So, Mumbai, we have many Bollywood celebrities who work and stay here, live here. So let's say if one has to do a valuation of a property like, Mannat, where Mr. Shah Rukh Khan resides, or let's say one of the bungalows where Mr. Amitabh Bachchan resides in Juhu. So apart from the fact that it is, the area, the rate which is going on in that area, there will be other factors. There will be an additional qualitative factor like, it was earlier, the person who was residing was a big superstar and it's a known address. Okay, so whoever is going to buy that particular property will have, in addition to the underlying numbers, he will also have a kind of a social status of owning that address, and that can be one of the driving force of valuation. Another example is, Tata's when they acquired the Air India, for example, recently. So they also said that, we wanted to have that because long time Mr. J.R.D. Tata was the one who had founded, so they used to earn that, they used to own that, Air India earlier. So apart from there being a business prospect, it also had certain emotional aspect and certain element of pride for the group, and therefore that was one of the essential aspect of having of considerations of valuation. Of course, you cannot attribute a number to it, but at the same time, you cannot ignore it, right? The other example can be, or that of, for example, where you have, if you have to value a property just right next to a graveyard. In that case, it may it may be the poshest of the locality, but you will not, find uh, too many bidders for that because you would, not prefer to stay next to a graveyard. So in that case, that qualitative aspect also plays a big role in the valuation. See, ultimately, friends, valuation is what? Something what an investor is willing to purchase, okay, are willing to invest, and something what the seller is willing to accept as a consideration for that particular asset or for that particular share. So qualitative aspect do play a big role in determining the quantitative factors. So for example, if the business, which is high growth business, let's say IT sector, right? You would have, your cash flow projections based on your MSAs, your signed orders, your customer sales book, etc. But let's say if you know for a fact that your product is not, it's become redundant, okay? Or let's say if you are valuing a car company today, okay, a motor vehicle car, and you know for a fact that there is a shortage of semiconductor chips in the market today, because of which you may have the capacity and the market to manufacture as many cars as possible, but there is a supply side constraint, and because of which you may not achieve the numbers. In that case, it's a example of a qualitative aspect which has a big role to play in the quantitative aspect of the valuation. So as much as valuation is a science, it is also an art. It is also, there is a social aspect to it, which has to be considered by the valuation expert in his valuation exercise. The quantitative factors include the business model, the government, the governance, and the market factors, whereas the quantitative factors such as financial statement analysis. So qualitative factors such as business model or governance. So for example, today, if one looks at the, let's say, automotive sector, for example, today, most of the automotive companies have a plan, or they would have already made a foray into uh, electrical cars. So that's like, without having some plan for electrical cars, you cannot be a player in automotive anymore. It can be the, the biggest of the brand. It can be international brands like, Mercedes, Volkswagen, or BMW, or it can be, our very own, Maruti Suzuki, or, Tata Motors, or whoever. So the business model and how you have, you have how you have forayed into electric cars, or how far you have embraced the new technology. Okay, uh, the softer the software qualities within the cars today, the passenger vehicles today, would have significant bearing on how much demand you can generate for your products, and therefore your future cash flows and operating profits, etc. So the qualitative factors do have a significant role to play in, and have a significant bearing on the qualitative factors of underlying the valuation. Intrinsic value is also called as the real value or the fundamental value of the shares. So basically, traditionally, conventionally, uh, the valuation was, based on face value of the share. So 10 rupee, 1 rupee, or 100 rupees, whatever the face value of the share. That used to be at one point in time the basis of valuation. These are like, I'm talking about 20, 30 years back. That is no more relevant now. What is relevant is what is the value the share can fetch in, when traded in a market. Okay. So the face value, of course, whether we are talking about a share which has face value of 1 rupee, or 10 rupees, or 100 rupees, that has a significant bearing, and you may have companies spinning off or going for split of shares, etc., which can have a bearing on the valuation. But the point here is that the intrinsic value has got nothing to do with the face value of the shares, and it can be lower than the face value. It can be much higher also as compared to the face value. It may or may not be the same as current market value. Now, it's very important to understand that intrinsic value is not the same as current market value, right? Current market value is the current quoted value. Okay, market value is, as I said earlier, it's an interplay of demand and supply. Okay, today, for example, if there is, so what happened? One of the reasons why people say that there was a stock market boom since last few months is because in the COVID scenario, many of the matured economies like the US and Europe, they distributed money to their people. Okay? They not just distributed money to their people, but also the corporates. Okay, by way of a dole out, right? Because of COVID-19. Now, because of that, the liquidity in the US, in the matured economies, it found its way in the emerging economy such as India. And there was a lot of liquidity that got created in the system. And this liquidity, when it attracted, the money was pouring into the capital markets, it shot up the value because there was a significant demand which got created, because of which there was basically, too much of money was chasing too few shares, and therefore it increased the prices. Hello. The call thing. So the point here is current market value is not necessarily the fair value or vice versa. Market value can have different, different aspects. It can have different dimensions to it. There can be various reasons why current market value is not reflecting the intrinsic value, and that is why as investors we have to find out which are the ones which are undervalued, which are the shares which are overvalued, and accordingly strategize stock market operations. Let me take a pause here for a minute and invite any questions or any perspectives from the client or from the participants. I don't see any questions as such in the chat box. So any participant has a question, can type the question in the chat box. Or I don't know if that speak up option is there, but you all can maybe type the question in the chat box and raise the question. Okay, so don't think there is any question. So let me continue. Valuation of a share. Valuation of a share is the process of knowing the value of the company's shares. So basically, valuation as an exercise is when you discover the price. It's nothing to do with price discovery, but basically you're valuing the underlying shares. Okay, so as I said, the underlying presumption is the investors or the valuation, the expert has full knowledge about the company's operations, and there is no, there is no opaqueness, or there is no, lack of transparency. Value of the shares depends upon both qualitative and quantitative factors. We discussed that. Quantitative factors mainly include financial position of the company, whereas qualitative factors includes reputation, image, people's perception about the company's growth and future. The share price of a listed company which are traded publicly can be known easily, but with respect to private companies whose shares are not publicly traded, valuation of shares is really challenging. So when it comes to investing, so one of the most difficult aspects of valuation is when basically you have to do valuation of non-listed companies. Okay, where basically you don't have a publicly traded quotes. In that case, what happens is you don't, first of all, you may not have the entire visibility about the, the company, the operations of the company, and therefore you may not it may not be possible for you to basically have the information. So in that case, one may, dig into the NCA website, get the last financial statements from ROC, and mind you, even the financial statements that are published by ROC would not have the full balance sheet, only selected items. I mean, P&L is not there, balance sheet is there, and schedules is there. So again, that may have some, challenge areas from the valuation perspective. Valuation of share is important for all its shareholders, stakeholders, governmental departments, and for national economy as a whole. So this exercise is basically important, not just from the stakeholders' perspective, but from government perspective. So for example, how valuable is, let's say, a Paytm today, or how valuable is an Alibaba, a Chinese company called Alibaba today, is of interest to government, because at times the decisions or the fiscal decisions can also be based on the valuation of shares. When valuation is required. Now, typically, one of the key aspects about valuation is, when is it required? So first and foremost, the most obvious thing will be when there is a buy or sale of business to know the business value. Okay. So when there is a transaction that has to be undertaken. So for example, it can be a sale transaction, it can be a sale of shares, or it can be a spin-off, it can be a share purchase transaction, it can be, a business purchase transaction. In that case, the two parties will have to determine the valuation of the shares for obtaining bank loans when shares are being offered as security. Many a times, companies raise loans on the basis of security of their shares, right? So in that case, the valuation of shares is important, because banks go by the basis of LTVs, or loan to value ratio. So if I'm lending you against the securities, then I need to maintain a certain LTV value, or loan to value ratio, because if my loan to value ratio is less, then it will have, some bearing, and therefore it will have some, impact on the regulatory aspect. So many a times also, many promoters of companies offer their shares as a pledge against the loans that they have raised, and therefore the valuation of those shares would be important from the perspective of the lender. Third point, on the event of merger, acquisition, reconstruction, amalgamation, etc. So when there is a merger between two companies, right? So when one company is merging with another, there has to be a ratio. There has to be the consideration has to be decided, and therefore the valuation of the merged entity needs to be determined. So, for example, if a holding company is, a subsidiary is being merged with a holding company, in that case, the valuation of shares of the subsidiary company will have to be determined. And accordingly, there has to be a consideration which has to be determined for the purpose of merger. Second is acquisition. When there is an acquisition, so for example, if one company is taking over the business of another company, or one company is taking over the shares of another company, there is an acquisition. In that case, also to determine the consideration, you will have to determine the value of the shares of the acquired company, of the target company, and that forms the basis of the consideration that will be exchanged, that will be passed on to the earlier shareholder or the owners of that business. Reconstruction, many a times companies undertake reconstruction exercise. It can be for better business operations. So, for example, a conglomerate may spin off one of its division and make it as 100% subsidiary, or it can be for various legal reasons. So, for example, now in insurance sector, the FDI limits have been changed, and therefore it may trigger some reconstruction from the investors. So if there is a reconstruction exercise, that again would have some adjustment, some truing up exercise of the shareholders' interest, and that would need to be adjusted by way of valuation. Amalgamation. So when there is an amalgamation, so typically under international, IFRS or Ind AS, amalgamation, reconstruction, acquisition, merger, it gets subsumed as business combinations. So Ind AS 103 is applicable in that case. So in such cases, you would have to have a valuation of the assets and liabilities as well as valuation of the consideration, the purchase consideration, which is important. So all these transactions would involve a valuation exercise, which will have to be undertaken. So, for example, let's say if Walmart is acquiring Flipkart, right? So, a few years back, Walmart acquired Flipkart. Now, Flipkart is an unlisted company, and it was, for millions of dollars. The consideration ran into almost $1 billion, right? So, what would have been the consideration from the perspective of Walmart? Right? So, Flipkart is, while it's a very popular e-commerce company, but it's still in having losses. Right? Now, despite of those losses, why would Walmart pay whatever consideration it did to the previous owners of Flipkart? One of the driving forces can be the GMV, the gross merchant value, or the top line, the popularity, the subscriber base of those, of that app. And that can be the forming part of the valuation. So it was an acquisition that happened where Walmart took over Flipkart, and there was a valuation that exercise that was carried out. In the event of conversion of shares, for example, preference share into equity shares. Again, when there is a conversion of securities from one form to another, there would be a valuation aspect that needs to be considered. And that is not only from a practical perspective, but also from a legal perspective. So, for example, Section 56 of Income Tax Act requires you to do a valuation of shares when you have, when there was a conversion of preference shares into equity shares. So that exercise you would also encompass. valuation exercise. At the time of offering ESOPs or employee stock option plan, so when so in recent times, ESOPs have or employee stock options have become very popular, especially most many startup companies. They believe that they may not have the cash resources to settle to pay their employees, but they have a promising future, and in order to incentivize or build loyalty to their employees, they may offer some employee stock option plan. Okay, when you issue employee stock option plan, you would have to do a valuation of the share of the stock options in order to for the financial reporting aspect also, and for the purpose of tax. So how much tax will be attracted by the ESOPs, that will have to be decided based on the how much based on the value of the stock options. In case of litigation, so for example, if there is a litigation between the two companies, there can be an issue of dispute that what is the true value. Okay, that can also have a requirement of a valuation. So valuation of shares can be required for various things. It can be for tax, it can be for Companies Act, it can be for a transaction, it can be for a capital market transaction like a buyback or a split of shares. It can be for various reasons, right? Now, friends, point here to note is that from the perspective of Companies Act, Section 247 of Companies Act requires that wherever valuation is done by under Companies Act, it has to be done by a registered value, right? So there is a registered valuers course that is conducted by the IBBI, the Insolvency and Bankruptcy Board of India, which basically it empanels professionals as valuation experts. So under Section 247 of Companies Act, wherever there is a valuation that is required, you need to have a registered value. Also, when it comes to valuation under FEMA or valuation under income tax, there has to be certain. So all these laws prescribe certain experts. What is it can be a category one merchant banker, or it can be a chartered accountant. So that those rules will need to be fully be followed in order to get the proper valuation under those respective laws. You cannot otherwise get comply with the legal requirements. So valuation as such can be required by valuation for because of a transaction which is being planned, or it can be by way of legal requirement, that is under Companies Act, under FEMA, under income tax, or under any other law. A point here to be noted is valuation versus pricing. What is the difference between valuation and pricing? So valuation is certainly not the same as pricing, because pricing is when the two parties agree to a price, okay, and the market, the shares are quoted at that price. Valuation is much more detailed and deeper exercise, where basically there are various assumptions, valuation techniques, valuation inputs, valuation, premise. So pricing is not the same as valuation. That is to be noted. So one example is, what is gold? So if I'm having bullion assets, or if I'm having certain gold biscuits, right? So what is so whatever the price of gold that is going on in currently in market, is that a valuation or is it a price? It is a price, but not a valuation, because you may not be able to precisely value gold, right? Why? Because it's so how do you value any asset, right? What are the operations? What are the, if you sell that asset, how much you will fetch? Now, use of gold is based for jewelry purpose or for industrial purpose. So you will have to have that, various assumptions, and you will have to do a proper exercise to determine gold. Now, that value would be probably different from the price of the quoted price of gold at this point in time. And therefore, what you have currently is the price, but what you will determine that, by a full-fledged exercise is the value of the gold biscuits that I'm holding. So both figures would not be the same. Okay. Another example is that of bitcoins. So many of you would have perhaps heard of the term bitcoins or cryptocurrency. Since last, few weeks, even, the finance minister and the finance ministry and RBI, etc., SEBI, etc., everybody is talking about cryptocurrency and legislation around cryptocurrency in India at the moment. Okay. Now, what is cryptocurrency? Basically, you don't know whether there is a crypto mining which happens somewhere, and based on that, there is a market which has been created through various platforms, and there are various cryptocurrencies like bitcoins or ether or some of the other ones, ethereum. So how do you value these? You would not be able to value this because you don't know what is the underlying. You don't know whether there is a underlying asset as such. There is nothing which is existing underlying those things. Okay. So, but then there is a price. Right? You have a market quote for cryptocurrencies. For bitcoins, for example, the trading level is running into millions of trades during the course of a day, which may be probably more liquid than some of our most popular shares or blue chip shares in India, right? So the fact that there is no valuation doesn't mean that there is no price, and vice versa. If you have a price, a quoted price for the stock or for the commodity or for the cryptocurrency, doesn't mean that that's the value of that particular asset or particular share, right? Both things are different. Pricing is essentially uh, what the market participants perceive the value to be and are ready to pay. It can be based on whether there's a shortage in market for that particular commodity, whether there is a promising future. So for example, ever since we have seen electrical cars becoming popular and becoming more popular, you would find lithium batteries, the demand towards the batteries which are required for electrical cars becoming becoming sought out, and the demand for that has skyrocketed. So it's not that the value of that is essentially the price which it is quoting, but because of the situation, the price has gone up. Or there can be a vice versa example. There can be an opposite example where basically, let's say if there is so for example, in Mumbai, when some of the properties of Vijay Mallya were auctioned, although they were in prime locations, but in the auction, they did not, fetch any value. In fact, the auctions, the participants also, many properties, they did not have any bidders. Why? Because it had value. Those properties did have value, but there was no price. Why? Because nobody was interested in buying those properties at that point in time. So, meaning here, friends, is that valuation and pricing are two different things, and often they are used interchangeably. But technically, that's not the right thing. Valuation and pricing would always be two different things. Again, let me pause here for a minute and invite questions from the participants. Madam, any questions? that you can see. I actually can't see any questions in the chat box. Is it possible to unmute any participant and invite any question from anyone?
Sir, so far no question, sir. Chat.
Okay. So I would encourage people to ask questions, because the beauty of such sessions is when there is an interaction, because otherwise I'm just speaking, in front of my laptop, and I don't know, like, whether people are listening or, it's adding any value. So please feel free to raise any questions, or share any perspectives. I'm sure many of you would be investing in stock market, or as such, be enthusiastic about valuation. So please ask questions or make the session more interactive, because otherwise I'm just talking in front of the laptop, so it may not be worthwhile. Okay, anyways, carrying on. Three important methods of valuing shares: book value, market value, intrinsic value. What is book value? Book value is basically, uh, it means, the literal meaning is that the value of the business according to its books of accounts as reflected on its latest audited financial statements. So this is the traditional way of doing valuation, where basically we were not looking at the future cash flows or the future prospects of the company, but we were assuming that whatever book value is there as of today will be what the investor, the shareholders will fetch. So whatever asset value is there as reflected in the books of accounts will be what it will fetch in the market. There won't be any change when the assets are sold as such or realized as such. Theoretically, it is what investors or ordinary shareholders would get if they sold all the company's share assets and paid off all its debts and obligations. So if on a realizable basis, if the shareholders were to liquidate the company, and if they sold all the company's share assets and paid all its debts or liabilities, that is the value which the investors will fetch. Book value is roughly equal to the amount ordinary shareholders, stakeholders, stockholders would receive if they decided to liquidate the company. Right. So basically, book value is what we used to do when few years back when we were kids, right? So that was what we thought that was the right thing of as the basis of valuation of a company. The underlying premise is that the stockholder, the shareholders, when they are in the process of disposing of the assets and settling the liabilities of the company, the assumption is that they will fetch the value which is recorded in the books. So book value is reflective of the fair value or the realizable value. So therefore, this is what reflects in the book value method. Now, book value method is certainly, it's not used as a basis of valuation in real life when there is a transaction that is to be done. So, for example, if Walmart was to use book value method as a basis to value um, Flipkart, then it wouldn't fetch any value because it's a loss company, right? Today, if we were to follow book value as a basis to value Paytm shares, it wouldn't fetch any value because it's a lost company. Zomato, again, I mean, there are many examples now, but most of these companies, Nika, etc. So there you won't find any, value because there is no earnings, there is no, book value. So therefore, this is a very old or redundant kind of a valuation basis. But having said that, it still has a usage because some of the legal requirements. So, for example, Section 56, Rule 11 UA, when you talk about valuation of unlisted companies, when you don't have any real estate or bullion assets in the balance sheet, income tax rules require book value to be the basis for valuation. So book value is one of the methods which, although it's kind of redundant, but still there is some usage in certain laws where it can get used for the purpose of complying with the uh, legal requirements, but certainly for actual transactions, such method is now becoming, it has become redundant. So let's take one example where basically you have to calculate book value per share. So book value per share is the ratio of net assets available for ordinary equity shareholders divided by the number of outstanding shares. That is, book value per share equals to total assets minus outside liabilities minus preference share capital, including arrears and dividend, divided by total number of outstanding ordinary equity shares. So basically here you have a scenario where you will minus from the total assets, liabilities, external liabilities, a preference share capital. Preference share capital, of course, preference share capital, of course, is somebody who is other than equity shareholders, and therefore, they will have to be reduced. And also, interestingly, if you look at some of the Ind AS concept, now book value in the context of Ind AS can be quite interesting. Why? Because in Ind AS, under Ind AS or under IFRS framework, many a times you have fair value which is used as a basis for measuring the assets and liabilities. So therefore, may also at times say that the book value is equal to the fair value. Matter of case for the matter is that if you are an investment holding company, right? So investment holding company holds shares again, and if under Ind AS 109, if the shares which are listed and which are not, in which the investment holding company is not having stake of more than 20%, then it's obviously reflected at fair value. So in that scenario, perhaps that can be one of the instances where book value is reflective of the fair value. Why? Because there is already the assets and the liabilities are being fair valued for the purpose of financial reporting, and that can be used as a basis for determining uh, the book value or the fair value in that case. So another here thing to keep in mind is that in terms of book value, now when we talk about the denominator here, that is total number of outstanding ordinary equity shares, we are talking about equity shares, right? in many cases, you will also have some dilution, right? For example, ESOPs, if you are issued employee stock options, or if you have, issued certain convertible instruments. So in that case, you will also have to consider the diluted shares, for the purpose of calculating the denominator, the shares that you will potentially issue subsequent to conversion of preference shares into equity shares or conversion of ESOPs into equity shares. So therefore, you will have to keep in mind that if you have a diluted certain instruments which are subsequently convertible into equity shares, you will also will have to take into consideration for the purpose of calculating the denominator the uh, the convertibility of those instruments. So, for example, if you have convertible loans or convertible debentures, also you will have to consider for the purpose of denominator the outstanding number of converted equity shares on a fully diluted basis. Second is market value. Market value is the most common, term used, and many a times it's interchangeably used with market price. Now, market value of shares is a price at which respective securities are traded in a stock exchange. It is essentially the price at which you can purchase or sell any share in the stock market. Stock market is heavily dependent upon the market demand and supply for such shares, which in turn is determined by the overall performance and growth potential of a company. So basically, from the perspective of stock market value, it is heavily dependent upon the market demand and supply of such shares, which in turn is determined by overall performance and growth potential of the company. In case of companies where shares are not traded in the market value per share will be calculated as the total market value of the business divided by the total number of shares outstanding for the purpose of market value. It is also referred to as the price a rational investor is willing to pay for the investment. Now, what is a rational investor? Whether it's a bear, whether it's a bull, it's a matter of judgment, and one can have different views about it. So basically, from the perspective of market value, it is also referred to the price which a sensible, rational investor is willing to pay, a knowledgeable investor is willing to pay for the purpose of valuing the shares. In most standard approach for calculating intrinsic value is similar to the present value method, the net present, the NPV method. So when you discount the future cash flows on current basis, where basically you have the future cash flows which are available to the investor. The most common method is the DCF or the net present value formula. And I'm sure many of you would be aware that, you will have basically the Excel formula, which talks about equal to NPV into bracket whatever. So then you will have, the net present value determined based on that. It is an estimation or projection on future value of its stock price based on business historical performance. So based on the past performance of the stock price, you would future. So one method is basically the dividend discount method, the DDM, where basically you discount the dividend cash flows arising from the dividend, and that forms the basis of the valuation of the shares. Although again, there are certain loopholes in that method also, because dividend in turn depends on underlying cash flows, and dividend policies may vary from company to company. So therefore you may have your own set of challenges with DDM also, dividend distribution, your dividend discount method also. But that is one of the one of the methods that is available for the purpose of this valuation. It is an estimation or a projection on the future value of its stock price based on the business historical performance. The fundamental or the intrinsic value of a business or any investment asset is generally considered as the present value of all future cash flows discounted at an appropriate discount rate. So basically, why discounting is required, that is to reflect the time value of money, because money realized 2 years later is not the same as money realized today. And therefore, I'll need to determine a proper appropriate discount rate. Oftentimes, we use WACC or weighted average cost of capital or incremental borrowing rate as the basis of discount rate, but there can be various. So generally, typically, if your borrowing rate, your leverage rate is different, then you would have a different WACC, and therefore the importance of setting the right discount rate. So, for example, you cannot have the same discount rate being used by a, let's say, a real estate company as compared to the, let's say, a FMCG. So discount rate has to also vary depending on what is the credit rating, what is the ability to raise funds, and what is the average cost of capital to that specific entity. What is the leverage? What is the credit rating? What is the existing borrowings, and whether if it's a debt-free company, obviously it will be a much lower discount rate because you would have the capacity to raise more funds. So there can be various parts, which group, which promoter group the company belongs to, which sector, which sector the company belongs to, which country the company has operations in, and various other things, and what is the current, general level of borrowings. So again, that can have a significant borrowing impact on the discount rate. The computed intrinsic value is then compared with the market value to determine if the stock is overvalued or undervalued, and accordingly investment decisions are taken. The computed intrinsic value is compared with the market value to determine if the stock is valued and undervalued at whether there is sense in making investment decision, or whether it has it has to be further there has to be whether it's overvalued or undervalued. So traditionally, most of these private equity firms, or even some of these financial institutions, because of the sheer size of mutual funds, because of the sheer size of their activities, they would do a proper valuation exercise and compare the value with the price to determine whether it's undervalued or overvalued, or underpriced or overpriced, and accordingly they would make their investments. So typically the retail investors may not have that much visibility or that much maturity as such, and therefore this exercise is generally not undertaken, but some of the more experienced investors do have, do undertake such valuation exercise. Most commonly used models for determining intrinsic value of shares, DCF, the discounted model is the most used approach to intrinsic value. In this method, the analyst forecasts the future cash flows of the business and discounts it to the present value by using the firm's weighted average cost of capital. This method is used by the investors when they are willing to acquire the whole company or controlling interest in the company. Similarly, when an investor is willing to purchase few shares of a company as an investment, he then uses the dividend discount method to determine the intrinsic value of the shares. Above computed value is the maximum amount that an investor would be willing to pay for the investor. So DCF involves three steps basically. Calculating the intrinsic value of a company using DCF model requires the inputs, the estimated future cash flows of the company, the discount rate to determine the present value of the estimated future cash flows, and a method for valuing the company at the end of our cash flow estimate, often referred to as terminal value. So basically you project the cash flows of the company. Okay, and this is the cash flow, this is not the profits, right? Because certain non-cash aspects, income and expense, you will have to exclude. For example, if you have depreciation, or if you have, invoiced amount but not collected, those non-cash items will have to be removed for the purpose of DCF calculation. Similarly, for the purpose of discount rate, as I discussed earlier, it depends on the WACC, the weighted average cost of capital. It depends on which sector the company is, which geography it belongs to, which promoter group it has, whether there's a past default history, what is the credit rating, what is the management like, whether it's competent enough, what is the business that it is into it, whether it's, a fast, cash rich business, or it's a, a cash guzzler in terms of long gestation business. So those kind of aspects will have to be considered while determining the discount rate. And finally, as I said earlier, the terminal value, that is, I may project the cash flows estimates for the next few years, but beyond that, I may not have a very accurate estimate about. And that is where I basically use the terminal value, that is the long-term average growth rate as a terminal value, and I use that as a basis for doing my doing my cash flow projections. So this is the formula for calculating DCF. So cash flow at the end of first year, CF as CF1 divided by 1 plus R, that is the discount rate, raised to 1, 2 or 3, whatever. So where DCF is discounted cash flow or the present intrinsic value of the company, cash flow in years 1, 2 or 3, TV is the terminal value, and then R is the discount rate. Let's take an example of a dividend discount method or this dividend discount model, where basically calculating the intrinsic value of a share using DDM requires three inputs: the expected dividend to be received after 1 year from the present, a dividend rate of return investor is expecting from the proposed investment, and the annual growth rate in dividend. One popular method for finding a company's shares intrinsic value is the DDM, where basically the basic formula of DDM is as follows. P equal to D1 divided by R minus G, where P is the present value of the stock, D1 is the expected dividend 1 year from the present, R is the required rate of return for equity investors, and G is the annual growth rate in dividend in perpetuity. So basically it considers that if you're getting dividend year on year till perpetuity, if you have, this dividend, then, it's based on the assumption that the company will survive for a very long time. Right? It's a very old, very conventional way of, valuation. Market relevance, it doesn't today have much of a market relevance, but at times, for a high dividend distributing company, it can be used. The above formula is also known as a Gordon growth model, GG. One of the difficulties with the value that the method of intrinsic value computing is very subjective exercise. Technique involves numerous assumptions to project the cash flow, thus the final net present value is sensitive to changes in these assumptions. So basically, the cash flows, if you look at the dividend and the cash flows, that can be very subjective. Okay, how much cash flows I'll have in future, and whether I'll have cash profits or not. That also would be subjective, and therefore that is an area where you can have a lot of arbitrary, or it can be manipulation, it can be anything. Another challenge is that while computing the weighted average cost of capital, the factors such as beta, market risk, premium, etc. can be calculated differently. Also, the probability factor that is used is subjective. So the other thing is basically when it comes to the volatility of the shares, one of the common variable that is used is beta. Beta is basically when the measure of basically how volatile your share is as compared to the general market. So anything in excess of 2.5 beta is something which means implies that your shares are extremely volatile. A market risk premium. Risk premium is basically how risky the shares is. Today, supposing if you have, say for example, case of Jet Airways, right, which is almost it's although there are some plans of reviving it, but as such it's the company is totally gone. So if I have to buy shares of Jet Airways today, or let's say any of these companies which are in insolvency, in this IBC code, then what is the risk premium? So there is a risk that is attached in buying the shares, of such companies, and therefore there is a risk premium. So what is the risk premium that as an investor I'm ready to bear? That is one of the judgmental aspects. Another challenging aspect. Lastly, the future is uncertain. So pre-COVID, whatever future cash flow projections had happened had all gone for a toss, right? So future is uncertain. Even today, we all talk about market revival, etc. And many optimists feel that we are out of woods so far as COVID is concerned. But all said and done, there are fair amount of uncertainty in the market today, and therefore projecting cash flows, be it for a company, for a group, or for any shares, it can be fraught with a lot of uncertainties, and that is one of the main challenges involved in this DCF or DDM method. Thus, while using the method, different investors can arrive at different values for the same asset. This difference is because everyone has a different way of looking at the future. Moreover, there is no way to say which number is accurate. So because of this aspect, that basically it's the cash flows which drives the valuation, and cash flows, how optimistically or how pessimistically you project those can be anybody's call. So which is why you have different valuations. So which is why you have valuation of, say, for example, a Kingfisher Airways of 25,000 crores, where basically brand was used as a, pledge for a loan. And then how much you value, how much value you ascribe for the brand can be, a very judgmental thing. And therefore it can be, when there's a litigation or when things have gone bad, the valuation, who arrived at that valuation, who gave that valuation report, who certified the thing, can be very controversial. So therefore, this subjectiveness of valuation as an exercise is always one of the challenging areas involved for the purpose of determining valuation using DC. So what's the difference between intrinsic value and market value? Intrinsic value is an estimate of the actual true value of the company's stock, whereas market value is the reality. It is the current market quoted value of the stock as set by the market. Intrinsic value is determined by the investors using financial pricing models. So you have, there's a fair element of scientific models which have been, established. Whereas market value, it is determined by supply and demand for a particular stock. Okay, it depends on how much that stock, that share is, sought after, how many people are willing to buy, what is the trading volumes, etc. So it will be, a function of all those aspects. Whereas valuation, it's a more scientifically determined value. Intrinsic value is calculated at the time of decision making. So generally, if one has to decide on whether to buy the shares for the purpose of, investing in the company or taking shares of that company, you will use generally intrinsic value. Whereas market value, it is predetermined and can be obtained from the market. It's the quoted price. It's a given kind of a thing. Like it or not, that is the value at which the shares are quoted. You may have, negative opinion about it. You may have a positive opinion. Whatever it is, you have to, it's a factual thing. You cannot challenge it as such. Intrinsic values determination involves use of assumptions like discounting rate, growth rate, and future cash flows. In case of market value, its determination does not involve use of assumptions. So it's a factual thing. There is nothing which is arbitrary or subjective. So market value is as such, it's given. Let's take an example. Mr. A wants to invest in shares of Paytm, which is trading at rupees, let's say 1,612 rupees, 0.450 rupees in the stock. Mr. A's required rate of return is 8%. A is expecting the company to pay dividend of 15 rupees after 1 year, which is expected to grow at 15% per annum. Now, in order to determine whether A should invest, he needs to determine the intrinsic value of the shares. Intrinsic value of the share using DDM equals to price equals to D1 divided by R minus G, where 15 D1 is the expected dividend for next year. That is 15 rupees divided by 8 minus 5. 8 is the rate of return that is expected by the investor. 5 is the growth rate at which the investor is, assuming or it's estimating the company's dividend to grow. So which turns out to be 500 rupees. 500 rupees is the intrinsic value, whereas it is being quoted at 1,612. So now the maximum A is willing to pay for the share is 500 for a Paytm share. In this example, Mr. A will not buy the share because it is extremely overvalued. If this share would be available at a price below 500, then Mr. A would be willing to buy Paytm share. So again here, such DDM method can aid your decision making when it comes to investment in stock market, provided you are very clear about what is your required rate of return. Whether it's 8%, whether you'll be happy. So for example, 8% can be, the average, let's say, fixed FD rate today is in the range of 5 to 6% maximum. So if you want a premium, a risk premium on that, maybe, top it up by 2% more. So 8% becomes your rate of expected return. What is 5%? That is the most challenging thing. After 1 year, how much you are expecting this company to grow, whether it's 5%, 50%, what? So again, while this method is useful, it's like a good kit to have in terms of valuing your stock prices, but it's not entirely foolproof as such. Let's take another example. B wants to acquire Nykaa company, whose shares are trading at 2,209.35 in the stock market. The total average number of outstanding shares are 50,000. Assume Nykaa's weighted average cost of capital is, that is WACC, is 10%. Company's last year's cash flow was 150 lakhs, which is expected to grow at 5% for 5 years, and terminal value at the end of 5 years is 800 lakhs. Okay. So terminal value is upon sale of the share of the assets, how much you will fetch. What is the value that you will fetch? Now, in order to determine whether B should acquire Nykaa, it needs to determine the intrinsic value of Nykaa. Intrinsic value of Nykaa's share using DCF is as follows. So you estimate the cash flows of 1 crore 57 lakhs, etc. for the first 5 years, and then you add the terminal value of 800 lakhs. So that sums up to 9 crore 91 lakhs. Then you have the discounting rate, discounting factor you use based on the weighted average capital of cost of capital of 10%. So you apply the discounting factor multiple, and then the present value, that is the cash flow expected multiplied by the discounted factor, get the present value. So you have the total, the summation of all the present values to be 11 crores 50 lakhs. So that is typically the intrinsic value that you are looking at from this company. Intrinsic value is the present value of the total cash flows divided by the total number of outstanding shares. So again, here you divide it by 50,000. So you determine the per share intrinsic value. So on a per share basis, it comes to 2,300 per share. So here, since the share is trading at 2,209 rupees, which is lower than 2,300. That is the intrinsic value. Hence, B should acquire Nykaa as its shares are undervalued currently. So on this basis, okay, you get to a conclusion that you should, take a plunge in the company. Why? Because the value, the price is much higher, but much higher, little higher than the actual intrinsic value. Sorry about that. So in this case, you have a case where the intrinsic value per share is lower than the current, market price, and therefore you may probably, sorry, it's higher than the current market price, and therefore you would perhaps consider buying those shares in the market. So, final words. Session. Intrinsic value is the true value of a stock or any asset. It should be used as investors, especially by value investor, for the purpose of decision making. Computed intrinsic value is compared with the market value, and investment decisions are taken The thumb rule for decision is that if intrinsic value is higher than market value, then investment should be made because the stock is undervalued. On the other hand, if the intrinsic value is lower than the investment, it shouldn't be made because the stock is overvalued in the market. So before taking any decisions on the basis of intrinsic value, care should be taken because computation of intrinsic value involves use of estimates and assumptions. At times, assumptions made may get right or may get wrong. So assumptions, valuation is all about assumptions. The assumptions underlying the valuation may be accurate, may not be accurate. So that is basically the gamble that the valuation expert is playing. Okay. The assumptions, any valuation is as good as the underlying assumption that goes with the valuation. So that is the bottom line. So with that, I think we have about half an hour's time for Q&A session. I would like to open up the discussion for Q&A. Okay, I have a couple of questions in the chat box. Yeah, so Mr. Sadananda R. Good evening, sir. I'll just read out your question first. Is there any regulation regarding valuation in the absence of which companies may value their shares at fancy prices? So, see, now I think your question is in the context of IPOs and stock market. So earlier, about 10 years back, SEBI had, a formula which gave the maximum price at which a company can come up with an IPO, the price at which the issue price of the IPO. Now, since last few years, what has happened is because it's a totally a market-based, mechanism that cap those, issue of capital regulations which were there under Companies Act have all, died down after this new Companies Act have, come into effect. And therefore, as we speak, there is no regulation as such, but obviously the investment bankers have to, get a proper valuation of the shares that are, offered for the IPO or for the offer for sale. Of course, there are valuation rules. The valuation report is accompanied, so the DRHP contains the valuation report, and therefore there is, the basis of valuation or even the assumption that underlie the valuations is visible to the investors and the underwriter and everyone. So there is no law as such. Of course, there are valuation standards, etc., which have to be complied with. But as such, it's more or less a free market. Now, one issue that is popularly being discussed is Paytm. Now, Paytm, of course, if you look at the DRHP, there was no DCF valuation, right? It was based on a market model, market multiple model, which meant that they were using certain similar company with similar profile, and they were taking those values as a market, multiple. Because in case of loss companies, there is no P multiple or EBITDA multiple also. So, how can you value such companies? So market approach is basically where basically you identify certain peer companies and then determine the value of those, and you make certain adjustments and you use that, derive that value. Now, again, I re-emphasize that valuation is one thing. Now, valuation may have given you certain answer, but the IPO price can be still different, right? So there is no restriction that valuation, whatever you have got, is what you should get the identify as the issue price. So pricing, and I had one slide also in the in the session that pricing and valuation are two different things. So therefore, you may have got one valuation done, but that's not necessarily that your pricing should be at that level itself. So all in all, to sum up, basically what I'm saying is there is no much regulation so far as the pricing of IPO is concerned. Of course, from valuation perspective, various law has different things when it comes to valuation. So today, if let's say if I have to fair value my assets and liabilities for the purpose of my balance sheet, certainly Companies Act would require the registered valuer to be there, and there has to be certain techniques. So, for example, FEMA requires certain methods to be followed. Rather, under transfer pricing, again, internationally accepted models have to be followed. So those things are there. But from the perspective IPO, it's based on investment bankers and the underwriters and what the valuation report basically gets you. Any other questions?
Only so many, sir.
Yeah, I think there's a perspective again, sir, Mr. Sadanan, saying that many companies are coming up with an IPO, value their shares exorbitantly, and after listing, there is a significant price drop. Yeah, there are a couple of cases. Of course, I mean, the market is very buoyant, the stock market, and many companies are wanting to, take the advantage of that. I see the concern that you're coming up with, but that's where the prudence when it comes to investors. So today, if let's say the last one, the what I read that the SIP inflows, mutual fund inflows, was a record high of I think it was 11,000 crores or thereabouts. So the investors should also be mindful that there are few companies which may not be worthwhile to invest in. They may look good from perspective of having a mobile application on your smartphone, but when it comes to investing, it may be a different kettle of fish. I think all in all, investors have to be careful what kind of shares they invest in. The issue date, the listing date, exit. So generally, most of the investors today are they have a feeling that they will invest in an IPO if laga to laga, and then let's say first day when there is it gets listed at a premium, they will make an exit on first dates. Such things are while there may be many cases, but it's all fraught with risk. So anybody else? Any other questions from the participants?
Manish, check any other questions?
No questions. Questions further? No questions, ma'am.
So can we wind up the session, sir?
Sure, sure. So, if there are no questions, I would like to thank the participants and, of course, thank the organizers for the opportunity and thank the participants. Hope they found the session useful. Thank you.
Thank you, sir. Members, I would like to take this opportunity on behalf of Bangalore branch to propose formal vote of thanks for today's investor awareness program. Wholehearted thanks to CA Santhosh Maller from Mumbai for sparing his valuable session. Thank you, sir, once again on behalf of all the participants and also on behalf of entire managing committee, sir. Thank you so much.
Thank you. Thank you, ma'am.
Members, thank you all of you for your active participation. Request you also to join on 21st December for the program on the same topic. We have a presentation by Sri Surya Kant Sharma on the topic mutual funds for wealth creation. Request all of you to kindly register and participate in it. Thank you so much. Thank you all.